Good evening, everybody. It is just past 6 Sunday evening, September 11th. David Edwards, President, Wealth Advisor here in Wealth. My colleague, Buff Parham, President of Parham Associates. People always want to know what Buff does when he's not talking to me, and he's a longtime speech coach, presentation coach, many years experience at CBS and Univision and various producing roles. Buff, let's jump right in.
Absolutely.
Oh, you know what? Before let's jump right in. So tonight's webinar is entitled, Don't Count on Luck, Count on Preparation. And I was thinking about this in the context of a sailing race that my wife, Randy Kaufman and I did recently. It was a long distance race, about 140 miles, starting from Stamford, Connecticut, sailing east to Buzzard's Bay, which is just off Martha's Vineyard, and back again. And the luck part of the race is the direction of the currents, how strong the wind is, whether it's a stormy, whether it's a hurricane, whether it's dead calm. The preparation part is analyzing 3 years of records from previous races to understand how long our boat would take, about 40 hours, and then picking a good crew. We had 6 people on board. Making sure we had a good mix of skills, making sure we had enough sandwiches to last 40 hours, making sure we had enough water. And then as we got into the last 24 hours before the race, we did an analysis of the winds and the currents and figured out a course. And people have been doing this race for 50 years at this point. And I was not in there to win the race. My goal was to be safe, have fun, and come back in a reasonable time. And that's exactly what we did. When we actually got into the racing, current is a big factor. Sailboats don't go very fast. The top speed of our sailboat is 8 miles an hour. You have to lean on the brake of your car to go that slow in your car. And then current is driven by tide. As the current floods, it drives a current of 2 to 3 miles headed west, and then when it ebbs, it sends a current 2 to 3 miles going east. And so if you're with the current, you've got 8 miles of boat speed plus 2 to 3 miles of current, you're going 11 miles an hour. And if the current is going against you, well, now it's minus. So you've got 8 miles an hour of boat speed minus 2 or 3 miles of current. Now you're only going 5 miles an hour. And that's kind of the experience we've had this year in the stock market. Last year, the wind and the current was in our favor, and the stock market went up 20%. And then for the first 6 months of this year, the current was against us and the winds were against us, and the market went down 22%. And it actually hit the low for the year on June 15th, and we had a webinar that weekend, June 17th, and I said, is there any hope for investors at all? And I said, yeah, there's tons of reasons why there should be hope for investors. And sure enough, the stock market rallied 12% over the next 8 weeks.
Did.
That guy Edwards knows something. But then the current turned against us again, and since mid-August, the market's been generally heading down. And so, as of this point in time, we're down 14% on the year, and that's not catastrophic. We have a good boat, we have a good crew, we're moving in the right direction. We'll get to our destination eventually. So I just wanted to bring that up because sailing and investing have a lot in common. You have your plan, your skills, and your experience, but when things break or things go against you, you just have to deal with it. And so this is kind of one of those just deal with it years where both bonds and stocks are suffering. So there was a great leadoff question, Buff. Why don't you start with that question?
Yeah, speaking as a neophyte investor and sailor, it comes as a bit of a shock to be caught in a historical moment when stocks and bonds are both going in the same negative direction. I was hoping that our bond mutual funds would act as some sort of ballast in these high seas. Any light you can shed on the bond market tracking within the larger macroeconomic picture at this point?
Yes. It is a very strange economy right now. On the one hand, many economists and bankers are clamoring for a recession based on the Federal Reserve raising interest rates. On the other hand, the economy, it's, corporate stocks, corporate revenues are booming, corporate earnings are booming. The jobs numbers are the best they've been since the 60s. Average Americans are actually seeing wage increases for the first time in a long time. And so we don't have a recession. So the stock market is reacting as if there will be a recession and marking down future revenues and earnings. But meanwhile, the bond market is getting hammered by rising interest rates.
Right.
Normally what happens if we are truly going into recession, stock prices come down, but bonds rally as people rotate out stocks into bonds. And here they're just selling everything. And the family that wrote in, they're new to our firm. They came on board, pretty much last September or so.
Mm-hmm.
And so for the first 12 months of their experience, they haven't made any money at all, which is very frustrating, and I understand that. And I can say, well, this will eventually turn around and eventually we will make money, but it's hard to be a new investor and experience that. It's almost like, when you're in the airport and the sign goes up and says flight delayed for you. Oh, that's so frustrating because, now I don't know now I know what to do. Versus if it says flight delayed 1 hour, you go, okay, well, that's not great, but at least I can go to the bar for an hour, look at my email and come back, when the flight's ready to board. So, sometimes in the airport, you do get a good forecast of when your flight's going to go, and sometimes you don't. Well, in the stock market, you never get an exact report of exactly when it's going to go up, but it always goes up. Ever since, modern economic times, 1945 forward, it's been up, it's been down, it's been up, but it always goes up. So anyway, I will say this about the bonds. We use bond mutual funds instead of individual bonds. And we use a variety of, and there's two choices in bond mutual funds. One choice is credit quality. So you can have government T-bills, bonds, notes. That's the highest quality, lowest yield. And then after that, you get agency bonds, municipal bonds, and then above that is high grade corporates. That would be the Amazons of the world, followed by high yield corporates, and then eventually preferred stock. And I will say that we use a package of these, and the yields were about 2.5% a year ago, and now they're 4.5%. So the yields are coming up even if the prices are coming down. And then the other thing that we do is we look at the maturity of the bond funds, and we knew for a while interest rates would be going up. So we deliberately have compressed our maturity band to between 3 and 5 years. A 30-year bond is very volatile to interest rates. A 3 to 5 year bond less volatile. Even so, it's been such a tough year in the bond market that we've lost money temporarily in the bond mutual funds. It will come back eventually.
Speaking of recession, is it safe to assume that we're facing a slight recession as opposed to a more brutal one? And is the inverted yield curve really a reliable signal at this point?
It is. Economists are tearing their hair out right now. There was so much residual disruption after the COVID crisis. And then on top of that, you have the war in Ukraine, that nobody knows whether the traditional signals are actually giving good information, right? So normally what happens is that when bond investors are anticipating a recession, they lower the yield on long dated bonds 20 to 30 years out and focus more on the shorter bonds. You get an inversion. Well, we don't have that happening. And in fact, the Federal Reserve is still coming in aggressively raising rates. So that signal is not telling us the normal information. And then the other question is, the GDP reports of the last 2 quarters were both negative. And that's a traditional indicator that we're in a recession. But meanwhile, there's another report, gross national income, GNI, says plus the GDP, and that is at a record level. So one of these two metrics is giving us bad information. Either GDP is not being calculated properly, and it may be revised higher, or gross national income is the better indicator, or maybe it's going to be revised lower. So it's hard to be a policymaker right now. You have to imagine the people at the Federal Reserve are really struggling to figure out whether they should keep raising rates. Now, my opinion is they'll keep raising rates at a brisk pace, at least through 2023, mostly because we haven't had a normal interest rate environment since 2008. Under normal circumstances, you would expect the 10-year Treasury to be 4.5%. And it hasn't been 4.5% since 2008. It's been more like, under 2%. And during COVID, it was down to about 0.5%. Now it's back up to 2% again. So there's room for interest rates to go higher. I don't think it'd be catastrophic for the economy.
And, the job numbers remain pretty positive. And, speaking of the Fed, do you think they'll see enough slowing of the economy before the September meeting to raise rates aggressively going forward again?
Yeah, I think the next meeting will be a 0.5% increase. It was 0.7. It was 75%, 0.75% on the last meeting. So the jobs numbers are interesting. Way back in the Clinton administration, they created this treaty, NAFTA, North American Free Trade Association, and that effectively shipped blue collar jobs to Mexico and Canada and overseas. And we learned the limits of outsourcing all those jobs to overseas in COVID, when all of a sudden we couldn't get stuff anymore. And even though COVID is not really a significant issue in the United States right now, it's still a very significant issue in China. They just simply closed down whole cities whenever there's an outbreak of COVID. So you have this constant interruption of supplies from overseas. And then also there's a strategic vulnerability. If 100% of your chip production is in places like Taiwan, and Taiwan gets invaded by China, it's going to be a big problem, making the stuff that we like. So there was a bill that passed the Senate recently, signed by President Biden, to onshore back to the United States chip production and actually invest a lot of money in doing that. And those are going to be great jobs for a lot of people. Now, the other thing that I never really like very much is that people that are economists are very eager to prescribe raising rates and killing employment, because when those job losses show up, it rarely affects white collar people, but it hits blue collar people pretty hard. So so your solution is to harm someone else in order to make yourself economically secure. I'm actually cool with inflation being high for a while. It's already coming down. Gas prices that were pretty high at the start of the summer, June, plus $5 a gallon, $5.25, are now back down to below $4. So we have a 20 or 10% reduction in gasoline prices. And I think that will continue as once we get past September, which is the end of the summer driving season. I think gas prices will keep coming down. So the psychology of paying $100 a tank, now we're back to $80 a tank. And in COVID, it was like $40 a tank. It's really crazy.
The right direction, though. When you mentioned my crude oil question, now get this, there's been some expert commentary that crypto can serve as a legitimate hedge against downturns in the equity markets. Really?
Yeah, really. Every decade or so, there's something that people get excited about. It was the internet era back in the around 1999 or so. And I remember there was a company that produced fish oil, and they rebranded themselves as an internet stock and just took off. Everyone jumped into it. So I have never allowed one of our clients to invest in crypto. I've always told them, listen, if you want to buy it for yourself, be my guest. I will not buy it for you. At the start of the year, Bitcoin, which is the best known crypto, was at 60,000 a unit. It was at 40,000 a unit by April. It's been around 20,000, 19,000, 21,000 the last couple of weeks. I do notice that there's a 100% correlation between the direction of Bitcoin and the direction of the stock market. And so what that means is that the same day traders that are trading crypto are also day trading options and futures on the market. And the two are tightly tied together. What I notice is that when crypto falls, it falls sharply. And then it kind of ekes out little gains over time and then falls again. And what's going on there is the psychology of people that are trying to get out of loss-making positions. Every time it goes up a little bit, they go, oh, I can sell some of my stuff. but then every time it starts to fall precipitously, no one wants to touch it. So eventually, Bitcoin will decouple from the S&P 500, which is there's real value attached to the S&P 500, and will continue down to 10,000 or 5,000 or 1,000. Most of the cryptos that have ever come out ever have been worth zero by now. And there was a fund, a couple of dudes from, I forget what university, they had a hedge fund that was invested in crypto. Well, it turned out it wasn't hedged at all. It was leveraged crypto fund, and they vaporized $1 trillion of their own clients' money in a matter of weeks. And then people say, why don't I invest? Well, because of that, I don't want my clients to lose that kind of money.
Conspiracy theory manipulation moving forward. Given the massive infusion of military aid from NATO, it looks like Ukraine is really winning a war of attrition against the Russians.
Yeah.
What should we expect to see next?
Yeah. So, why do we care about the war in Ukraine? Well, because Ukraine is a major exporter of grains. So that an inflationary impact around the world, especially in Africa, Asia, and where people try to eat. It has an impact on the price of energy. Right now, the Russians are pretty much shutting down gas transfers to Europe this winter. So then the Europeans are going to hustle around and get their gas from somewhere else, and it's hard to load up on a big ship and transport. We said when the war broke out last February that for Putin, invading Ukraine would be like swallowing a porcupine. Hard to get in, even harder to get out. And of the scenarios that we worried about at the time, the first scenario was overnight successful invasion. Didn't happen. Second scenario, what we've seen for the last 6 months, which is a war of attrition. The third scenario is the Ukrainians actually push the Russians out of Ukraine. Fourth scenario is nuclear war. So hopefully we won't get to that.
Yeah.
So now we're in the third phase. The Ukrainians are starting to push the Russians out. And the reason why they're able to do that, I think it's very simply boils down to morale. The Russian soldiers don't want to be in Ukraine. There's nothing in it for them. And given a choice between, running away or surrendering or deserting, you see that a lot. On the other side are the Ukrainian people. And the population of Ukraine is about 45 million. There's about 10 million able-bodied men and women who this is their homeland. And what we've learned from the Vietnam War and what we've learned from the Russian invasion of Afghanistan and what we've learned from the American invasion of Afghanistan is that people will fight and fight and fight and fight and fight for their homeland. And the Ukrainians are better organized, better morale. They've been getting very advanced weapons from the Americans and the Europeans. They've put them to good use. The Russians have simply been lobbing dumb shells downrange with no particular strategy. They're running out of shells. It was noted this week that they're now buying artillery shells from North Korea, which is kind of a sad commentary. The Chinese are not providing them with weapons because they're afraid of harming their own relationship with the United States in terms of manufacturing exports. And just in the last 24 hours, we saw the Ukrainians overrunning an entire province in northeastern Ukraine. And now that puts more pressure on the Russians in the south, who have a very long, thin line across the top of the Black Sea. If that line gets severed, all of those troops get encircled. And I'm trying to think of what Putin's mind is right now. He just seems to be delusional about how things are going. He spent Saturday, opening a Ferris wheel park in Moscow. That's not serious. So we'll see. We're also getting into winter, and it's going to be a lot harder to fight in the wintertime than it is in the summertime. Mud is the soldier's worst enemy. I don't think things are going well for the Russians.
No. Speaking of Putin, we're watching him curtail transmission of oil and gas to Europe. What's the eventual ripple effect on this move with the U.S. equity markets?
Yeah, so the United States is a net exporter of energy products right now, oil and natural gas. So we're kind of isolated. We'll have energy here. Prices went up because the whole world was reconfiguring transportation routes. And now things have settled down a fair bit. And so a lot of Russian oil is now going to India and China at a discount. The Europeans are in a tough situation because they don't have a natural replacement for the natural gas they were buying from the Russians through the North Sea. They've mothballed a lot of their nuclear power plants. They're going to have a tough winter. They're going to have to tough it out.
Yeah.
I think the Americans will be relatively isolated by comparison.
Well, that's all I've got. How about you?
Yep, I just took a quick look at the chat session, and we'll give people 1 minute to toss in a question or two, and then if not, we'll kind of take it easy tonight. Here in upstate New York, it's still summertime, but already we see some leaves turning. And where you are, it's probably a solid month to go before the leaves start to turn.
Yeah, we're still in the 80s.
Yeah, well, we're here in the 60s. So anyway, so Buff, I didn't see any questions come in, and
Okay.
so we're gonna enjoy the evening off. Have a good one.
Glad to have you back.
Yep, thank you. Bye.
Bye-bye.